having a lot of money can actually create problems. In fact, it can create more surcharges and taxes. Today, I'm breaking down 4 hidden challenges that tend to show up when your assets grow into the 7 figures and beyond. We're going to start off with required minimum distributions. We're going to flow into capital gains from taxable brokerage accounts, then to IRMA surcharges because your income's getting higher, and then lastly, Social Security benefits because there's a really significant tax trap. Today, we're going to dive relatively deep into these 4 elements, but I'm coming out with 4 subsequent videos about each topic individually because there's so much more depth that I want everyone to understand, but they require their own videos. So make sure to hit that subscribe button so you get notified when the next videos come out over the next couple of weeks. All right, first is a required minimum distribution. An RMD is the minimum amount of money that must be withdrawn from a tax-deferred retirement account each year once you reach a certain age. These distributions are required to prevent individuals from deferring taxes on their retirement savings forever. The IRS wants theirs. The RMD is not optional once you reach these required ages, and failing to take it can lead to significant penalties. I mean, real big penalties. The RMD is calculated by using the prior year balance on December 31st and a very specific life expectancy factor based on one of 3 tables that the IRS provides. Table 1, Table 2, Table 3 in your particular situation will guide which table to use, but most commonly used is the Uniform Lifetime Table. For example, let's say you had a $2 million balance on December 31st the prior year, and this next year you're required to take a distribution from your IRA or 401k. Your first divisor is 27.4. We would find that on one of the tables. $2 million divided by 27.4 equals $72,992. That's a huge distribution. So in continuing our discussion on required minimum distributions, here's it in practice. You can see here this person, Jimmy YouTube, is 65. But if we scroll down here, you can see the income coming in is just Jimmy's Social Security. And to meet his needs, he's distributing assets from his joint brokerage account, which has a little less than $2 million in it. But you can see here when he turns 75, required minimum distributions start. And overnight, his tax bill over doubles because he's actually having to mandatorily distribute more assets than he needs in retirement. These required minimum distributions increase your tax bills and kind of are a hidden kick of income that you may not need, but will most likely have to spend in some capacity. So RMDs are something that we want to try to navigate as best as we can. Next are capital gains, and capital gains are the profits made from the sale of an asset such as stocks, bonds, ETFs, mutual funds, real estate, but we're not going to talk about that stuff. We're talking about investment accounts like a taxable brokerage account held at your regular custodian, Fidelity, Schwab, Vanguard, wherever. Specifically in a taxable brokerage account, capital gains arise when an asset is sold for more than its purchase price. It's called the basis. For example, you buy a stock for $5,000, you later sell it for $7,000, your capital gain is $2,000. That $2,000 is taxable. If it's sold within 12 months of buying, that's a short-term gain, that's ordinary income. If you have a lot of income requirements in retirement, or you're a high income earner, or you have a lot of assets, that's gonna bump you into the higher tax bracket. That's like making traditional money. It's gonna be taxed at the highest tax bracket. If you sell it after 12 months, that's a long-term capital gain and is taxed at more favorable rates. Depending on how much money you make, it could be a maximum of 20% with an additional 3.8%, but most people are gonna fall into the 15% capital gains bracket. And if you're in retirement, depending on your strategy, you could be spending years utilizing taxable brokerage accounts for retirement. All right, so now we're talking about capital gains rates. Going back to Jimmy YouTube, you can see these zeros on planned distribution. Well, Jimmy here needs a lot of income. He wants around $200,000 a year of income, which is not uncommon for people with a really high net worth. Social Security is not gonna cover it all, so we need to make distributions. You can see here from 65 to 75, we're actually using that taxable brokerage account. In this particular instance, you're going to be creating taxable events by liquidating gains. Now they're taxed at a more favorable rate, but you can see here that you're going to be creating a taxable event by distributing assets from your joint brokerage account. This is a great tool, and it's a great way to work through retirement because you will be in a lower tax bracket because you're avoiding RMDs for later. But this could be the window of time where you want to start doing Roth conversions, which we'll get to towards the end. So now we're going to talk about IRMA. IRMA is a mechanism that ties Medicare premiums to the beneficiary's modified adjusted gross income. If your income surpasses a set threshold, you'll be required to pay higher premiums than those who fall below this income limit. This is when you start taking Medicare. The surcharge is based off your MAGI, your modified adjusted gross income, which is calculated as your adjusted gross income plus any tax-exempt interest, which is like municipal bond income in your state. They're going to add that back in. The Social Security Administration reviews your income from 2 years prior to determine whether you'll be subject to IRMA for the current year. For example, your 2025 premiums will be based off your 2023 income. Your 2026 premiums will be based off your 2024 income. So let's take a look at this chart really quickly. So you can see here with this chart, based on your income and your filing status, you could be adding an additional surcharge onto your traditional Medicare premiums. You can see it works all the way up to an additional $628. Most people aren't going to be in that range, very few, but most people could be adding an extra $185 to $259 onto their standard premiums for Medicare. These are some pretty big surcharges that are really going to add up in retirement. And here's what this means in practice. If you have Social Security, each month they're going to reduce that Social Security to most likely pay these premiums. That's how most people do it. So that means you might have to withdraw more from your investment portfolio to supplement the income that you want. And then lastly, Social Security, and specifically I'm talking about the taxation of Social Security. Social Security benefits are subject to federal income tax depending on your total income, including sources like pensions, IRAs, other earned income, investment income. The taxation of Social Security benefits isn't really straightforward, but there is a specific calculation they use. It's kind of complex, and it involves calculating your combined income, also known as your provisional income, and comparing it to certain thresholds. Provisional income is your adjusted gross income, adding back your non-taxable interest, kind of like IRMA, and then 1/2 of your Social Security benefits. That's the calculation for your provisional income. Once you know your provisional income, you run it through these specific brackets, and up to 85% of your Social Security could be taxed. This is called the Social Security tax trap. It really brings in a lot of Social Security and it makes it look nasty. And I'm going to show you what that looks like now. And here's the Social Security tax trap in practice. You can see here on a tax return, you can see Social Security benefits. Jimmy YouTube is going to receive $31,980. But you can see here as we scroll over to line 6B, $27,183 is going on his tax return as income. So that is the Social Security tax trap, where because the income is so high, your expenses are so high, we have to make distributions from investment accounts to meet your income needs. I thought I'd leave you with one quick tip on how to avoid a lot of this. Since a lot of these adjustments are income based, we start to ask the question, how in retirement can we reduce income? Well, first I spoke about required minimum distributions, where you have to distribute tax-deferred dollars and that goes onto your tax return as more income. Well, what if you put more money in a tax-free state? I'm specifically talking about the Roth. The Roth IRA is a way to get more money in and deferring and accumulating. And so when you withdraw it in the future, as long as you don't break the rules, that all that money comes out tax-free. So if you're young enough now, your 50s or your 60s, you have the ability to start making adjustments and planning now over the course of multiple years. It's not one just burst that's going to clean this up. It's planning over multiple years to be able to prepare more assets in a tax-free state to help adjust some of these things. If you need help with things like this is what I do all day, every day. This is my specialty, retirement planning at its best. Feel free to contact me below or go to propathfinancial.com, and we'll see you next time.